What if I told you your safe investment might be way riskier than you think?
Yep.
That S&P 500 index fund sitting in your retirement account? It might just be the financial equivalent of a Jenga tower, and we're ulling out the bottom block. Because while everyone's been cheering on passive investing as the holy grail, there's a growing trap no one's talking about, and it could shake up the future of your portfolio. Passive investing, it sounds boring, right? But boring has made a lot of people rich. Instead of picking individual stocks, passive investors buy the entire market, usually through an S&P 500 index fund, which mirrors the performance of the 500 largest publicly traded U.S. companies. And it's not just a trend, it's a takeover. For the first time in history, more money is now in passive funds than active ones. That means most investors are no longer trying to beat the market, they're simply trying to be the market. But here's where the trap begins. The concentration problem. Think buying 500 companies gives you broad diversification, right? Well, not quite, because right now just 3 companies, Apple, Microsoft, and Nvidia, make up more than 20% of the entire S&P 500. Let that sink in. 3 companies at 1/5 of your index fund. And if you zoom out to include the so-called Magnificent Seven, Apple, Amazon, Nvidia, Meta, Tesla, Microsoft, and Google, you're talking about nearly 30% of the entire index. In 2024, those 7 stocks soared 31%, while the other 493 companies, they grew just 7.4%. So what's the trap? You're not really buying 500 companies. You're betting big on a tiny elite, whether you realize it or not. Let me know in the comments. Did you think index funds were equally weighted across all 500 stocks? Part 3. It's not just the US. Now you might be thinking, okay, but that's just the S&P 500. I'll diversify globally. Smart, right? Well, not so fast. This concentration issue isn't just an American problem. In China, the UK, Canada, and Australia, the top few stocks dominate their indices too. For example, Canada's index is dominated by banks and energy. Australia's by mining companies. China's by government-linked megacorporations. So if you're investing passively across multiple markets, you're still placing concentrated bets on a few sectors, just different ones. Part 4, systematic risk you can't hide. Let's talk about systematic risk. That's the risk you can't diversify away, no matter how many ETFs you own. If the entire market drops, guess what? So does your index fund. This is especially true when inflation spikes, interest rates rise, or consumer sentiment tanks. And speaking of interest rates, Part 5, interest rates, the market's gravity. Interest rates are like gravity for the stock market. When rates are low, stocks float higher. When rates rise, gravity kicks in and valuations fall. The Federal Reserve has recently paused rate hikes, giving investors a breather. But don't get too comfy. Long-term inflation pressures are still lurking. And if the Fed decides to tighten again, that could be a rude awakening for overvalued stocks, especially the tech giants propping up the S&P 500.
Consumers right now are expecting a 7.3% inflation rate for the next 12 months, which is the highest number since 1981.
The Wall Street Journal just reporting that Walmart plans to cut 1,500 jobs to help manage expenses and speed up decision-making.
Part 6. Are we in a bubble? Let's talk numbers. The price-to-earnings ratio of the S&P 500 is currently around 37. That's more than double the historical average of 18. To put that in perspective, this is the 3rd highest valuation in history, just behind the dot-com bubble and 2021's COVID-era boom. When markets are priced for perfection, even a small miss can trigger a big fall. Are we due for a correction? Maybe, maybe not. But here's the key takeaway. When the market is this expensive, the margin for error is razor thin. Drop a fire emoji in the comments if you've made it this far. Part 7, the ETF evolution and dilution. Now, modern ETF products have gotten, let's say, creative. Sure, there's your classic S&P 500 tracker. But now there are ETFs for cloud computing, AI, and robotics pet care. Yes, seriously. Even inverse ETFs that bet against the market. The problem? These niche ETFs seem diversified, but are often heavily concentrated in just a few high-growth names. You're just doubling down on the same handful of stocks from your main index fund. It's like ordering a variety pack of snacks and finding out every bag is just Doritos. Part 8. The long game still matters. Okay, so here's where we zoom out. Despite all these risks, the S&P 500 has historically returned about 10% annually since 1957. That's through recessions, wars, inflation shocks, tech booms, and pandemics. So if you're investing for the long haul and regularly adding to your portfolio, you can still build serious wealth, even with the occasional bumps along the way. The trap isn't the S&P 500 itself. It's thinking it's bulletproof. Smart investors don't blindly trust the market. They understand what they're buying. What do you think? Is the S&P 500 still a safe bet, or are we headed for a shakeup? Drop your thoughts below. I read every comment. If you're learning something new, smash that like button. It helps more than you know. And don't forget to subscribe for more real talk investing insights every week. Let's recap. Passive investing is still a powerful tool, but it's not immune to risk. The S&P 500 has become top-heavy with just a few stocks doing most of the heavy lifting. Systematic risks like inflation and rate hikes can impact everyone, even diversified investors. Specialized ETFs might not give you the safety net you think they do. But despite all this, long-term investing still wins. So stay informed, stay intentional, and most importantly, know what you're holding. Or check out this playlist to level up your financial IQ in just 10 minutes a day. Thanks for watching, and remember, boring investing is often the smartest kind.